This is Justin Pulitzer. This is my weekend review for Sunday, January 10th, 2016. Last week was the first week of the new year, as everyone knows, and boy, was it fairly eventful to the downside. I think a lot of people were caught off guard by this, but I can't say that it didn't catch me. I can't say it caught me by surprise. I actually was pretty much expecting something to this effect. I don't know that I thought it would be this dramatic. But I was interviewed on the prior Friday, the 31st, on this Benzinga morning show, and I was pretty bearish, and I kind of laid out a scenario in the S&P 500 that I will get into here in a bit. But let's just jump up to it and kind of show you what's going on and how I see this kind of playing out. And I always like to start off with my 6 market keys, that being the VIX, the dollar, the bonds, the oil, China, and the IBB, which is the biotechs. And let's start out in VIX. In prior, I guess, panicky sell-offs, or I should say in recent sell-offs, anything that kind of has held at 25 has abated. And the only time, this was the Friday before the flash crash, which was, of course, here on 8/24, this was the only day that we really convincingly and solidly closed above 25.20. And you can see here on Friday, we did close solidly above the 25.20. So I had said that I thought that there could be some solid weekend risk. I don't know if things are going to be as dramatic as they were this day, but it wouldn't surprise me to see, a little bit more follow-through on the downside. And I'll go through that with some of the levels. But someone had DM'd me this weekend, and they had asked my opinion about the VIX, and they asked me about Fibonacci retracements and would I use them in the VIX. And I've had this Fibonacci up for a while, so I can tell you we are getting a little bit close to some of them. You can see the 38.2, the 28.27 was a reference high here. I happen to think, though, if we don't lose this 25.20 in short order, that we may want to come back up and retest into these 33s, which would be, we have some reference highs up here in 31, and then the 50% fib is 33.04. Wouldn't surprise me to see that early this week if we, like I said, if this doesn't fade quickly, like if there's some type of a move up and people start getting freaked out. I had been saying, look, we had been seeing some higher lows. Now we are kind of trying to see some higher highs, which is troubling. I mean, if you're long a lot of equities and you're a bull, you don't like to see higher highs with higher lows and now higher highs again. So let's be a little bit careful. I think that just keep this chart in mind when I go over SPY, which I will in a little bit. One piece of encouraging news was UUP. This is the dollar ETF, and the good news is that we now have a lower high. We broke back into the kind of the range, and you have kind of 2 back-to-back bearish days, both stalling at the breakout and below the 50. We did, however, close basically, I think a smidgen below, but basically right on the 20 and just below the channel. You can see trying to, or I shouldn't say the channel, but I should say the kind of uptrend. So we are a little bit below there. Slightly encouraging. I did notice in pre-market that the dollar was trading a little bit lower, so that is good. My biggest fear for the market going forward this year, besides, obviously major ramping in interest rates, would be an out-of-control dollar, because that will destroy the earnings for S&P 500 companies that do business overseas. So a little bit encouraging with the dollar. We really do need it to break, though, below the 25.23 to say maybe the top in the dollar, at least for the interim, is in. It's still, obviously, this can reverse very quickly, and if it does and this trend breaks, that's going to be even more clobbering time for the market, that is. The bonds, they have been strong. I mean, they're nowhere near their highs, but they are near the 2009 crash peak, which is 123.15, and we actually did close over there slightly on Friday. We are a little bit below the, I had drawn 2 scenarios here, one of the up channel and one with the down channel, and it looks like they both not come to fruition. But I do think the bonds don't really need to kind of really rip or fall apart as long as they kind of just hover around strong. It is, I guess, I would say a net positive for the market. If this really starts falling out of bed, that to me gets bad. You'll have to see more PE multiple compression. I think a lot of people get fearful if they see bonds spike. So if they kind of maybe spike in too dramatic of a fashion, short term, it would be a negative for the market. But in the bigger picture, stocks like lower interest rates, that is good for stock prices and PE multiples. So just keep that in mind. We are kind of playing footsie below the channel here. So if it can break up, maybe it gets the 126s. Anything above 126 to me would be, I guess, more bullish than bearish, for at least for the TLT. But in the meantime, it is good that it is holding in. Somehow the TV media seems to think higher bond prices are bad for stocks. You know, when I was in college and I studied finance, basically I was told that, and I mean, this is just simple math, that stocks are valued on a DCF method that's a discounted cash flows. And, you know, when you're dividing something, it's better if you're dividing by a smaller number than a larger number. Really that simple. I don't really know how better to describe it, but, you know, if you have a large denominator, you're going to have a lower end product. You have a smaller denominator, you're going to have a larger end product. Really rather simple and elementary. One of the big drags on the market is oil. You can see USO has made new all-time lows, which is not good. Anything below 1237 is vulnerable, and I will flip into the absolute contract. I guess the kind of one saving grace here is that it is kind of hovering around these 33s. I think that I had really thought we were going to try and bottom a little bit sooner here between 37 and 33.20. I'm going to go back on a little bit of a longer term chart though to show you, I guess, what could happen. You can see this was the 2009 crash low. We are slightly below there. That is not good. That does mean that I don't know that we are going to come down and retest these 17s or whatever, but there are some more reference lows roughly around here in this like 24, 25 area. You can see that there was old resistance back here, and there was a lot of time spent around there. This is also sort of like a little bit of a reference volume node. I don't believe that oil is sustainably lower down here, but it doesn't mean that we can't see that obscene final flush to get down there. Oil did break the trend, tried to rally, broke again, tried to retest check back, and now is breaking. So I mean, the oil chart is pretty fugly at this point. That is the truth. And I'll tell you, when oil was up here and up here, the market was keying off of oil, and it was basically every uptick in oil, the market would go down. So now basically at the other extreme, every downtick in oil, the market goes down. Once that correlation kind of breaks, that's when I think we will see the kind of the more stable bottom in the market. China. Gotta have your China. Take a look here. China is in kind of the grips of a pretty nasty situation. I'll say this. We never got back up to the old all-time highs in the FXI. We are still pretty far away from the all-time lows, and we are basically around this 61.8 fib. I was a little disappointed this one hadn't hit here exactly. I did wind up playing long here, though, and did get out. I had talked about that I thought we would. Let me bring this into more modern times, although for the purposes of this chart, I want to show that we are into some near-term reference lows here around these like 31s. We're kind of getting close to there, and if there's another break, we could fill this triangle up down to 2861. I'd probably be an interested buyer somewhere between there and like the 26s, at least for a short-term play. Anyway, let's get a little bit closer. you can see that we had this massive breakdown, missed the 61.8 by a little bit. We did rally back up, though, to, I think I need a little bit more of a longer time frame. Sorry about that. I have been using the 2-year. We did rally back up really to the neckline of this sort of big topping pattern and then have rolled over now and made new lows. So China is still bearish, and unfortunately, it's starting to get steep. When you have steep China, you have problems in the U.S. markets. I will show you, though, that this didn't necessarily only start in China. I believe a lot of this is to do with Federal Reserve policy, and I am going to show that once we get to the S&P. Boy, have I teased that S&P chart up a lot. I better do a pretty good job doing my analysis. But China here started to list back, kind of found a little bit of support on trend, and then has just done the dumpster dive, well below the 61.8, well below this reference swing low. So lower highs, lower lows, bearish. Kind of, that's really the only way to look at it. A lot of people have looked to biotech. I would say a lot of those people, I would be in that camp as a proxy for risk on, risk off. You can see this was had a head and shoulders, had the breakdown, had the check back, had a subsequent breakdown, slightly higher low to the flash crash low, and then kind of rallied back to like where this really got going and tested 1, 2, 3 times. Looked like it was trying to kind of rally up, and now has a failed pattern and is kind of back down. The I guess the good news is we're still in an uptrend. I mean, this, be it a suspect one, we are basically right on trend. So if this snaps, I think we'll see these lows again. We never got a full retest of the 61.8 or of the breakout around 275, which I really was looking for here. I actually was looking to get long that in biotech here, and I missed it because it didn't quite get there. It rallied up quite strong. It is coming back down. It never quite got there again, though. Disappointing. The bad news is if it gets there this time, it is so close to these lows, and a break of these lows I think will bring in more of a cascade type of selling that would take biotech considerably lower. So maybe even down to these reference lows here around the 247, like 250 area. It's also the 78.6 Fibonacci level. So this is really very key here in the biotech. You have a failed kind of bullish pattern. It is now breaking down with lower lows. So yeah, I mean, it's pretty iffy. I'd be a little bit cautious. This, like you can see, this was a congestion area, really, where the main breakout was. So if this snaps, I think it's playable with a put spread or a put ratio down for a retest of these lows. And then there'll probably be some kind of like minor bounce, and then, maybe more of a rollover. I'm really careful on this. As long as you are below these 341s and 342s, I am very suspect of IBB at the current moment. Everyone always talks about how it's cheap and the PE multiples are low, but when an industry is topping, that's always when the PE multiple does look the lowest. It's called peak earnings. We do know there's going to be probably more regulation that comes into these types of names, so I would be a little bit cautious. Let's get into the one more thing with IBB. The best of the breed, Gilead, can't kind of catch a bid for the life of it. Look at this. It just kind of ugly listing. This looks like it's setting up for a bit of a larger break. I probably would be a put seller down near these 85s just because it's been sort of some support in the past. And I think, again, it would probably hold at least for a short bounce. And the IV will probably get jacked. So if there is some type of a move, preferably ahead of earnings, that would be great. Kind of get the shake before the bake. Coming down into earnings would be a good play for that. I do like put spreads or put ratios for that ahead of time. So without further delay, let's get into the very well teased and much anticipated SPY analysis. So the expected move next week is $6.28. I think that would take you down roughly to these like 80 reference lows. A rally up here would take you up to some of these gap fills and also more of this breakdown here in the 99s. So that's really how I see it for this coming week. I believe the futures, last I looked, they were rallying a little bit off the lows, but they had been down. So I guess I do think a lower open is a little safer than a gap up. You saw what happened on Friday. We had that gap up on the quote-unquote goods jobs numbers, which I'm going to discuss in a moment, but they really weren't good, and we wound up having a rollover. Once you took out the prior day's low and the 61.8 from the flash crash, things got rather iffy, and you had a bit of a dump into the close. I think it was a pretty underwater close, if I remember. Let's take a look. Yeah, you could see VWAP up here was like in the 35s, 36s, and it wound up just being a bit of a cascade into the close, which was rather bearish. And yeah, we're kissing down by these lows now in the pre-market, or the after hours here. So there are a couple of reference lows here that are important. I will show you the supports that we broke down, and I believe I left off here last weekend, and I had said I didn't want to really panic anybody, but I guess we were bearish, and it was sort of, I guess it should have been panic, but I did say that the last time we closed below this low was here before the flash crash, where we had the cascade below the 204.12, and it wound up being a gap. They tried to rally it Tuesday, wound up coming back up to the 201.90, and then we rolled over in dramatic fashion, stopping, I guess, hitting every ugly branch on the tree on the way down. We did stop at the 197.86. This was really the opportunities the bulls needed to have. They wound up losing it. It got the gap fill that really kind of price hovered there a little bit. We got the 61.8, and then Friday was just kind of ugly. So when you lose 61.8s, it sort of gets people thinking 100% retracements can be in play. There is a very minor trend line here that has worked a couple of times here. So I don't want to fully discount it. It is very possible that we do bounce off of that again. But the real big primary trend comes into play down near these. I don't think we're going to get it in this exact timing. That would sure be something if we did have that type of a move this week. It is totally possible, but I think a little bit unlikely considering we've come down this hard this fast, and we are kind of coming into some other past reference lows. But I had talked about this being kind of the mountain. I used a reference here of calling this the mountain, and we had this big consolidation pattern here. We resolved out of it, but albeit very timidly, and then rolled over in dramatic fashion to the other side, and now we have been trading on the other side of the mountain. The bad news for the bulls here is that we have rallied up with a significant rally to a slightly lower high, although kind of feeling a little double topish. We've got this sort of consolidation pattern here, which reminds me a little bit of this, but instead of breaking up and out, we have broken down and away, and that to me is a little dangerous given the amount of time we spent up here. I mean, we've been consolidating for the better part of a year, almost 2 years. I mean, this year was an entire year up to here, up to 2015. So we basically went nowhere, and look at all the months we spent in this from the prior year in this sort of range. I mean, basically, this is the better part of 2 years we've been consolidating. So I will say this, if we do lose these lows, I do think we will test this reference low of the 173.71, and that to me would signal that we probably have a big top formed in the market because of, look at the symmetry. We'd have the two lows here, we'd have the two lows here, and that to me would say that we're likely, we'd probably get a rally. I'm not going to say that we're just going to sail right through there. I do not think that that is going to be the case, but I do believe that the rally would probably only come back up into somewhat of this range and would likely roll over and fail. Is that a certainty? Is that a guarantee? No, but it is one type of a scenario. So I am looking early. I did say early next week. And we do have some. Like I said, we closed away from value quite dramatically. We had a dump into the close Friday, panic selling, and we have down futures. So you have overnight inventory already net short and you're coming in off of an oversold condition, the market is very oversold in the very short term, clearly still overbought in the long term, and well oversupplied, and we've been dealing with distribution. But I am thinking that there will be some type of a responsive play. I don't know if we're going to fill this gap completely, although that would be an amazing area for a right or right out short again between the 204 and 205. That would, I think, be an amazing gift at this point. But I do think that the more likely is that we would rally back up to retest this sort of breakdown area. I had said that if we lost these reference lows, it would be a bit of a waterfall. It's a bit of a delayed waterfall, but I do think that this is considered pretty nasty price action. So I do think if we rally up, we're probably going to be contained to 199 to 200. And if we do roll over, we do have these reference lows here. We have the subsequent bounce higher low. So I do think that this area here is probably the near-term, short-term target before there is some type of a bounce. It's also very conceivable that futures reverse and we get some type of a gap up on Monday. I think that to me would signal that this is probably a bit of a short-term low for now, and then maybe we get the rally up here. Probably likely just to roll over again, but like I said, this is kind of newish territory for us. We haven't had a trending market in quite some time. I'm not really willing to say that we're in a full trending market just yet, although it's starting to look, I will say it is starting to look that way. So what's going on here? We are on the wrong side of a Federal Reserve policy error, and I'm going to show you that here and how that played out. This was the Fed day. Wound up being a bullish day. I think there was a lot of people who had sold out of that already. You got a bit of a rally up here. Relief rally, short covering. You got the move, and then the next day you had this bearish engulfing pattern as people realized that the party might be coming to a bit of an end. Gapped down after being, keep in mind this sold off all the way from the top to the bottom, had a big gap down and sold down in dramatic fashion again down to reference lows. And then we had the short covering rally and a move to a lower high. We did kind of break back into this area, and I had said that we really needed to clear with conviction 107s. We stalled in 107s, rolled over. I've been saying, by the way, besides 107s, that I thought that the market, as long as it was below 210 and 211, and you're welcome to go back to past videos, that I was cautious on the market. I told everyone up here at the big 1.618 fib, it seems like so long ago, that this was the time to really start to liquidate longs and to get a little bit more cautious. It took a little while to play out, but it wound up being correct. I am very, very cautious here. The economy is not doing well. I don't really care what anyone else has to say. I don't really care what anyone else's analysis is along these lines. The truth of the matter is I actually don't really listen to anybody. I could be in a room with 100 people and they could all tell me one thing, and I will only be convinced that I am wrong and that things are different if I am losing money. That is that, or if I'm seeing things that, visual things that I can quantify. We had a crappy jobs number on Friday. I really don't want to hear anyone tell me it was a good number. I know that they all focus on the headlines, but the truth is it was a lot of temporary hiring. It was a lot of young kids getting jobs for the holidays, wrapping presents or doing working in stores, which we know all did horribly. And I think that we're probably going to be seeing a lot of layoffs. I don't even want to say I know we are, because Macy's is closing 35 stores. That's going to be hundreds and thousands of people out of work. So the jobs data that all the talking heads want to say was good was really crappy, and it was not a good day Friday. Sorry to tell you that. The GDP numbers have been awful. The Atlanta Fed lowered their their GDP forecast. All of the big banks have been lowering their forecasts. I mean, some are like 0.7. They're all basically below 2%. Stall speed economy, not good, very subject to shock, very subject, to being kind of in, quote-unquote, the margin of error. So we could potentially already be in recession or entering recession and not even knowing it. I think it's a very, very high probability that we may be, frankly. We had a really lousy fourth quarter. Historically, the last 2 years, we've had pretty crummy first quarters. This is obviously not starting off, doesn't look like we're starting off in a good way. We had a junky ISM number. I know that the talking heads were kind of trying to calm people down and say, oh, no big deal. It was only the manufacturing, and we're not a big manufacturing country anymore. And then the services one came out and was recessionary also. We had a recessionary PMI. All of these were contraction. They were all contracting. They were all below 50. Durable goods orders were, I guess a push, but I think that they were, everyone was like, oh, they were the same as the last time. But the problem was the last read was junky. The only things that have been really holding up have been autos, planes, and housing. And not planes, but autos and housing are very subject to consumer credit. And if that starts tightening with the Fed raising rates, that will not be good. That will be very detrimental. I talked about the dollar. I don't want to review that again. And then the other issue I see is the S&P 500. This probably hasn't fully gotten the attention of the Fed yet, although they're probably looking. But if we start getting a little bit more like this, steeper, which is very, very possible, I believe that they are going to have to acknowledge the policy error. I don't know if they're going to reverse it because people in our society aren't forced into accountability anymore. They'll probably just paper over it, but they'll say, they're on the sidelines. I don't know. I don't necessarily know that they're going to reverse it the first shot, but it really honestly should never have happened. You don't lower... you don't start raising interest rates into a slowing economy. I don't know where they were in 2013 when the market was up 30%. That might have been a good time to have raised rates. Now things are not going well. We know about the Middle East troubles. We know about the deflation that we've been experiencing and basically across the board in commodities. And I want to address that directly here. A lot of people keep saying, oh, the commodities don't really matter, that we're just, it's going to help the consumer, and that, most sectors of the economy benefit from lower energy. And they are correct, but they are not looking at time frames, and I'm going to explain that right now. 17, maybe even lower at this point, 15 to 17% of the S&P 500 is made up of energy companies. And oil is a direct component of GDP. As that contracts, as all these companies start firing, which they already have, Chevron came out and basically said by any means necessary they're going to maintain their dividend. That means cutting CapEx. That means cutting jobs. They will slash and burn before they cut those dividends. Exxon will do the same. All of these companies will do the same. And I believe that that contraction in GDP could be enough to maybe tip us into recession. Longer term, yes, I do agree that lower energy costs were a huge throttle on the throat of growth for both Europe and Asia, and that will kind of help dig their way out of some of the problems they're having now. But I do believe that things are softening. The economy is not well. So that is my story with the macro rant. I hope that was helpful. Like I said, let's wrap up SPY. I think that the move could be down into these reference lows. If there's a bounce, I think it'll be either to the 197.86 or maybe up to the 199, sort of maybe at the max. If we start getting above there, I'll talk about some more analysis, and what that means to the pattern. With regard to some of those big companies, the Exxons, we are not near the lows with oil, which is interesting. I think a lot of people are buying these because they realized, although it is well, it did sell off with the market, but we're basically around that 61.8. I don't know if this is necessarily going to hold again, but this is an important level for Exxon. I think that people are basically thinking that they're going to benefit from buying assets on the cheap when all these sort of smaller companies go bankrupt. And I think that they believe that their dividends are fairly safe, at least for the time being. I do believe if you must own oil, that it would be those two stocks. They do pay the good dividends, and I do think that those dividends will be safe for a little bit of while. Chevron is actually at an interesting right or right out point. I don't like that it's making a lower low, but I do like that we're right around the breakout in the 61.8, so this could be a good area, and you can see it did bounce a little bit. Would be a good right or right out area. If you want to get long this and you want to kind of do it the Chicken Little way, maybe sell some out of the money puts as a long proxy. Some of the other big ones. These were big winners from last year. Nike had the 2-for-1 split. I had talked about this looking very toppy with this big reversal. I think traders took the split and the good earnings as an opportunity to sell. Sell into the big market when you can, not when you have to. This was one of the only big stocks that had a lot of big gains going into the year, and now we are starting to roll over, making lower lows. I do think that Nike is going to set up for some type of a bounce play soon. You can see that the gap fill is roughly coincides with the 200 MA. That was some support back here, roughly some support here, although it did trade below it a little bit. I actually would prefer something around the 61.8 or maybe even primary trend if the market really gets kind of steep early next week. So I'll be looking for that. I'll really be looking to probably sell some puts that are jacked when IV is high, or keep in mind this is coming down off of an all-time high. So this is probably going to have to rally to see a lower high before the thing completely would collapse. Maybe down all the way. But I do think that there should be some type of a play somewhere in the 55 to lower 50s. Somewhere in that $5 is probably going to be a tradable spot. Disney has also been very emblematic of the market. You had this kind of collapse. It roughly held trend, higher low. Basically came up to fill the gap. It wasn't a complete perfect gap fill, but it's a lower high, and now we're kind of testing and just breaching trend. This is a very key level here. If Disney starts losing 97.77, this swing low, I do think we will test well into this range of the flash crash. And more importantly, you probably could see the 95 area. So I think that somewhere in this bar, there'll be a tradable bounce, again, just because you've come down so far, so fast, so much into some reference lows. So I would be looking to kind of buy Disney, kind of BTD in Disney, maybe close to 90 if you could, somewhere between 95 and 90. I do think that there'll be a tradable bounce. Maybe sell some out of the money weekly puts just for that week, but I do think that we are going to, just because it's been so far, so fast, so steep, you'll break the trend maybe, and then there'll be the check back. So that's sort of what I'm looking for with Disney. But these stocks all are looking rollover-ish, looking very top-ish, not really great for the overall market. One other piece of bad news, and boy, am I ever so cheerful tonight, is the IWM. We are below those lows, flash crash lows, all reference lows. The only saving grace that I can say here is that we are close to trend. There is a channel low, a little bit lower if this does break, which is around 101. And we are also around this 103.54, which we kind of basically stopped on. So you're at a reference low near the uptrend, and kind of, I guess there's a little bit of room below to the lower part of this channel. This is starting to get oversold. It's bad that it broke here. I do think it's bearish, but I do think that it's probably sold off a lot already, that the next move down will probably be tradable for some type of a throwback bounce. But I do believe that the trend here is obviously down. Lower highs, lower lows, but chasing the short after this much down is usually a recipe for disaster. I like put ratios for a move down into here, and then trying to maybe loading up to play for a bit of a bounce. So that'll give a little bit of relief, but I do think that this is very bearish. Larger picture, so short-term oversold, bigger picture, kind of pretty bearish. The Qs, not quite as bearish, but showing some signs of toppiness. This was basically a double top. We spent a good amount of time here breaking down. I did think the 105, 104 level was important. I do still think, look, we basically filled the gap. So this is kind of where this needs to stop. If we get bearish, and I'm going to talk to you about some of the names that have held this up, that could be a catastrophe for the Qs, but we lost this 61.8. I do believe that this bigger 61.8 would be a good area, somewhere between 94. Let me see, where was this gap fill? Close 94.39. I think between 94s and 96s would probably be enough of a sell-off right from, keep in mind we were at all-time highs, that there'll be some type of a relief rally. If this really gets out of control, I would love a primary trend touch down. If this kind of waddles around for a little while, it would be amazing. Maybe not because it's too far out, but I was going to say I would love if trend coincided with the lower part of the body here in the 94s, but I think that's a little bit too much of a tall order because that would take a lot of time to get there. But if there is some type of a move down to the primary trend, I do think that, like I said, that's going to be a playable bounce area. Maybe it takes till here and it kind of coincides with this low here, 90. Look at this, 90, 90. Like if we could kind of get down there, that to me would be a great setup. I also like playing that with put ratios. Like if we kind of get down into here and you can get that kind of a spread, that would be a good play. But that's a little bit ahead of ourselves here. That's a longer time frame. I think a lot of people sometimes will try to play for that and not realize they've come down so much and that there are other levels in between there, and they kind of get themselves zeroed and, like they'll load up on puts and then be like, oh, well, why didn't it get there? These lows, I'm sorry I don't want to. I want to wrap this one up quickly. We are here. This is an important low. This is the end of the range distribution, which is roughly coincides with here. So I think somewhere between where we are closed and these reference lows will probably find some reference support in the short term. Some of the bad news. The Apple. So Apple is into a measured move support and some reference support here near these 95s. You can see the move here. If you overlay that move onto here, it's roughly around the same. It's into one part of a channel low. This is another part that I kind of drew in a little artificially, but I think it'll work. So I think Apple between 95 and 92, which was the flash crash reference low, might hold it short term just because it's gotten so far so steep. Bigger picture, believe it or not, we could see the 61.8 in Apple, which is roughly 85.72, and the primary trend is just a little bit below there around 83s. So if we get some kind of like really sloppy open on Monday and you get I don't know that this is going to happen, but if you get a gap down into that area, it could be a good right out long trade. Bigger picture, if we do get that complete move, close to 75 is believe it or not, I set it up here that it would be really possible to get down there, and I still believe that it is possible. Things happen in stages. I don't believe it'll be a straight shot. If you're so inclined, you can put an order in, for like a flash crash type of an order. Maybe you get lucky and it gets filled. But I do think that we are coming into some key support, a channel low, a reference low, a tail line of support that we know has been a little bit important. So there should be some type of a bounce somewhere between 92 and 95, in my opinion. Maybe it rallies back up to the 100 or the 103. But anything below 100 and 103 to me is vulnerable, and Apple to me looks toppy. Lower highs, lower lows, the stock is not looking super-duper healthy. The one thing I will say that I liked, that Apple had a little bit of relative strength on Friday, and it had a host of downgrades, and it was mostly green for the day. I think it actually did even close a smidgen green, but it was stronger than the broad market, which we know was in complete collapse. Apple can kind of be a little bit counter-trend sometimes, but I would say that the fact that it wasn't destroyed on a really bearish day with 3 downgrades kind of might mean we're getting a little bit closer to a tradable low than we are, of course, up at the top. They do have earnings coming up. The more that this gets steep, the more panic you get ahead of there, the better this will probably set up for a bounce play. Let's just go to the meat of it, FANG, Facebook. So Facebook did what I had said. We were in this consolidation. It looks like it's breaking the, I shouldn't say it looks, it did break down out of this channel. I think that one of the reasons we weren't a little bit stronger here was that these lows didn't retest the 99.24 breakout. We are getting a little bit mid-range here, which usually tends to be support. When you break out of a range, you come into mid-range. I think that the kind of the worst of it for Facebook, and listen, I could be wrong, but for me, I think somewhere between 93 and 86 could be a good playable low. This was a big breakout area. It's also a big 61.8 from the flash crash low, which really shocked me. 72 was a key old support. See where it held in the flash crash? So we know that, this was a key resistance, which became key support. 86 was a really key resistance for a while too. And you could see this was kind of the pullback low. So it wouldn't shock me that if that was retested, I think that would be a really good area to kind of load up and buy Facebook. Keep in mind, it's coming off of all-time highs. You do have earnings coming up, which will probably be good. The 200 MA has been prior support. This is all coinciding with these levels, by the way. This is roughly in the 92s now. By the time it gets there, although who knows with Monday, maybe it is right to that area. So I think between 93, that's 92, 93, and 86 area, to me would be a good area to buy. If you want to play put ratios, that to me is okay as well. If we get back up above 99.24, you can kind of forget about that area. Anything below there has it in play. Anything above there is still into the upper distribution and probably still has all-time highs in play. I am short-term a little bit cautious with Facebook. Longer-term, bigger picture, I'm still rather constructively bullish on Facebook. Amazon, it had a bit of a failed breakout. I think a lot of people didn't realize that this had moved like $60 in like 2 days. 36 bucks in like 2 days. That's a lot of movement. It didn't quite get to the 700. It had premature sellers. It is now getting close to this kind of uptrend low from here. The major trend line is, of course, still lower. I would love to see that visited ahead of their earnings and set up for a good long play, a bit of a shake and bake. But this could potentially support if Monday doesn't turn into some kind of disaster. If it does, we have some fib levels below there, the 50 and the 61.8. I really would love to see the primary trend from this gap retested and to set up for a right or right out long. The best scenario would be just a complete straight, move, maybe some minor bounces, but get it a little oversold. Get out all of these chasers, get them out, get the demons out, right? This had a big consolidation up here. I had really been telling people to kind of lighten up at the 1.618. I guess I was a little bit early. I mean, it did get higher, but I think if you did sell up there, you're probably right now a little bit happier than not. I often say this, and I think it's very hard for particularly newer traders to understand that it isn't as important to sell the exact high price as it is selling at the right time. If you can really truly absorb that, you'll find your performance doing significantly better in the big picture. It's frustrating short term when you see higher highs made, but getting out at the right time, like I said, is more important than getting the exact right price. Netflix, I had taken a lot of heat on the stream saying that this was looking very double toppy to me. It turned out that was correct. We held 115. We rallied, lower high, consolidated here, gapped below, basically got to my target level of, I was saying 105 to 110. We got the 105s. And then you had this amazing piece of news here about Netflix going basically global. It kind of took out the down channel. You had a bit of a failure, though, the following day, and you are now basically back below there. I think that anything below 115.03 is vulnerable. You're right on the channel here. If you're long, and you're still in there, I think 110 kind of has to be your stop. So I'm cautious below 115. Anything above 115, we're still talking about highs being in play. So if this day was completely taken out, we took out the 117.72, and we got over this 117.91. So let's just say we clear 117s and we're into 118s. It's hunky-dory. Anything below this, though, is getting suspect, particularly if we lose 110. I would get the F out. Google, probably the cheapest of all of the Momos in terms of their PE multiples. I said we were getting a little close to the channel high. We didn't quite get exactly there. We're kind of rolling over a little bit. It wouldn't surprise me that if we sort of had this kind of price action where we filled some gaps, maybe we fill in the gap. That would be great. Set up again for a long, maybe for earnings. I would think that that would coincide well with this sort of channel low. So if we get some early weakness next week, you might want to be able to get into there. I wouldn't even mind if it got a little bit more extreme and got kind of into these levels. I mean, I might be asking a little too much. It's a really big move. Particularly, keep in mind we're right off of all-time highs. So the first move off of all-time highs usually is safe to buy for some type of a check back. It's usually when you have to worry is when it's coming off of a lower high, like kind of like we are in SPY. But with this, I do think that there'll be some interest in this one, particularly if it goes lower ahead of earnings. So let's see how that plays out. I think we should end it there. I've been going on long enough. We're about 45 minutes in. Anyhow, I hope you liked my video. Please leave some comments. Please hit the like button if you liked it. Be sure to follow me on Twitter. My handle is @JustinPulitzer. And be sure to just hit the subscribe button below for my YouTube channel, which is where you're watching this. You'll get notifications when I post new weekend review videos, Periscope rebroadcasts, or special edition videos. Anyhow, let's have a good week, and cheers.